Good morning. This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Friday, everybody. We finally have a green week, which means I finally get to be excited on the podcast. So I am very happy to be able to have a change of tone here. And we have some things to cover. We have stocks we're going to talk about. We have stock market news from this week. And we're going to go over some of the biggest investment managers' predictions for the end of the year S&P 500 predictions. Okay. And they've almost all changed. They've almost all lowered their numbers. And I just want to talk about that briefly because I've said this for years now. And I said it when I was 24 and I'm saying it now that I'm 32. Not me, not you, not your grandmother know what the stock market's going to do. Not Warren Buffett. Nobody knows. Okay. However, there is evidence and data that allows you to make a very good opinion / estimation of what's going to happen. And that really is all the job is. Okay. You will have financial planners and financial advisors, and they do vastly different things, but they almost all get paid on what your portfolio does. And that's not good. Okay. Because you pay a financial planner to sell you insurance and allocate your IRA based upon your risk tolerance. They're not trying to make you money with lowering your chance of losses. They're just putting you in a risk tolerance profile that somebody else manages. Okay. That's not good. You don't want that. Okay. And then you might have a financial advisor that's like, hey, if they do well, I do well. So now I got to try and be more aggressive. You don't really want that either. You want a fiduciary, someone in the middle. And I don't know, my mind just went this way. I have no idea why I just started talking about that. Not what we're here to do today. Today, we're going to talk about the fun stuff. We're going to talk about the market and why it's doing well. And we're going to talk about predictions from the fund managers. And then we're going to talk about the stocks we like. Because we had one of our loyal listeners wants to hear some of the stock picks. Like we did that a lot last year, right? These are the stocks we like. This is why we like them. Not a lot of new stuff this year. We're doubling down on some previous picks. And there's a few new ones, but for the most part, guys, we think that this market is going to explode. It's literally waiting. It's like a spring that's just coiled up and ready to just, right? Like a volcano, Yellowstone. Once that happens, instead of lava, it's going to be money. For those of you that are invested, at least, okay? Invested in the stock market. So, all right, let me read the news here and we will, guys, normally I wait until the market close, which is in 20 minutes. I couldn't do it. I couldn't wait any longer. I just needed to get on here and talk stocks with you guys. It's too exciting for me. Okay, stocks were higher late Friday afternoon, extending a 3-day rally that put major indexes on track to post weekly gains as investors keep close tabs on development related to tariffs. The S&P 500 and tech-heavy NASDAQ composite were both recently up 0.7% and 1.2% respectively, while the Dow Jones added less than 0.1%. Stocks recorded big gains the past 3 days as investors reacted to a slew of quarterly earnings reports from major companies and the possibility that President Donald Trump could scale back his tariff plans. Which, again, all part of exactly what we said was going to happen. These tariffs are not meant to actually swing. It's just meant to show you that he can swing. Okay. Or he, I mean us. Despite the recent surge, the S&P 500 had gained 3.8% this week through yesterday's close. Uncertainty remains about what will happen with tariffs and what that could mean for the economic outlook. The Trump administration, which earlier this month paused for 90 days its plan to impose wide-ranging reciprocal tariffs, has said it's negotiating with dozens of countries. Investors are particularly focused on U.S.-China trade relations. The countries have imposed tariffs in excess of 100% on one another, amid conflicting reports on where talks between the countries stand. Shares of the world's largest technology companies were leading the charge higher Friday. Tesla, woohoo! If you guys know us, we love Tesla, which has surged since CEO Elon Musk earlier this week said he'd start spending more time at the EV maker and less time with Doge. Tesla is up 10%. The stock was benefiting from news that the White House plans to loosen rules for governing autonomous vehicles. AI chip maker NVIDIA jumped 4% and Meta Platforms added 3%. Google rose 1.5%. And Apple, Microsoft, Amazon, and Broadcom all gained a little bit of ground. Among other noteworthy post-earning movers, Charter Communications, CHTR ticker, stock soared 11% after the company added more mobile phone lines. Intel was down 7% after the chip maker issued a disappointing outlook that overshadowed better than expected first quarter results, while shares of T-Mobile tumbled 12% after the cell phone service provider said it added fewer wireless customers than expected. Bitcoin was at 95,100, up from an overnight low of 92,900, giving stocks tied to crypto a boost. And MicroStrategy, MSTR, the big Bitcoin buyer, formerly known as MicroStrategy, was up 6%, while crypto exchange Coinbase Coin and Bitcoin miner Mara Holdings, MARA, each tacked on about 2%. The U.S. dollar index, which measured the performance of the dollar against a basket of foreign currencies, was up 0.1% at 99.47. Sorry guys, give me a second. Oh yeah, the index Monday hit 97.2, its lowest since March 2022, as concerns about tariffs and their potential impact on the U.S. economy weighed on sentiment. So, all right, what does any of this mean? What is all this? It means that even though there hasn't been any tariff news, the market, aka the people, investors, we believe that things are trending in the right direction, which is true. Okay, and we've mentioned this the last couple of weeks, that anytime there's an inkling of news, even a whisper of a possibility of a tariff deal, the stock market responds positively. So once these things get solidified, signed, and codified, it's going to be a no-brainer. The stock market's going to trend north significantly, I think. Now, again, there are variables, right? We have war, we have maybe China invades Taiwan, all this stuff. We can't really predict exactly what's going to happen. But there's evidence, okay? There's evidence that these things are positive. And just like last week when I talked about how the financial planner wanted to diversify Deshaun out of the stock market, the U.S. economy, and he used it as a defense metric. Well, when you're in international stocks, you're diversifying out of risk. I'm like, what are you talking about? And then it actually makes zero sense. Why would you want to be in a lower consumption, lower GDP, high risk equity market than in the US of A, baby, stock market? And I'm not saying it like a loyalist. I'm saying just look at the numbers, look at consumption, look at GDP. Even in bad times globally, let's just say global bad times, the US still produces and consumes more than every other country. And honestly, more than multiple countries combined. So that makes zero sense. You want to be, one surefire way to make more money than everybody you work with or other people in the world is when the stock market drops like it did recently, right? 1,000 points roughly. More than 1,000 points, 13 or 1,400 points, is to put your cash in the stock market, just the S&P 500. Okay, that is a surefire way to do it. And look, I actually that's a little bit risky for me to even say this because it's not personal advice. I'm just saying generally, this is what generally would happen. In 1 to 2 years, right? The average bear market lasts 18 months. Or I think it lasts 10 months, the average one. But historically, every other recession except for the Great Depression was recovered within 24 months. So we'll just use 24 as the safety net. So if you were to put all your cash at the very bottom, right, or even dollar cost averaged on the way down, you would have now gotten 15% on that money in 2 months. Okay, that's what people get in a whole year. That's what some people get in 10 years because they're diversified out of the market. They don't know what they're doing. Or they're in retirement, in which case they shouldn't be in the market. But anyways, that exposure to the market is very, very important. And I think of this story about Michael Jordan, and this is a horrible, horrible story. But there was a bench player, let's just call him Bob. And Bob never played a minute in the NBA Finals. Didn't play a single minute. But he was celebrating and really excited in the locker room and just enjoying his time because he had just won. He was a part of a world championship Chicago Bulls team and never played a single minute. And Michael Jordan looks the guy dead in the face and said, "What are you celebrating for? You didn't play a minute. Like, you didn't play at all. Like, you didn't do anything to help us get here." And then the guy's whole entire demeanor, facial expressions, everything about him just deflated, and he just felt horrible. And first off, that just makes me love LeBron 10 times more. But that realistically is what it's like when you don't invest in the stock market. You are that guy, but after Michael Jordan insults you, where you're just deflated because you didn't really get to do anything. You didn't really get any of the value of getting all those gains from the stock market. So that's where we're at. We think it's going to boom. We're very excited about it. And now I want to read predictions real quick. So let's see. So Wall Street Bull slashes outlook for S&P 500. Okay. I just want to read these numbers. So these will be companies you've all heard of. Okay. Where are we at? Why is this? Okay, here we go. Sorry, I had to go search through Yahoo News for it. So Wells Fargo was at 7,007. And they stayed. Wells Fargo stayed. Morgan Stanley has stayed. So Wells Fargo is the only positive one, which I'm not a big fan of Wells Fargo because of what they did in 2008, but they have the highest predictor of the stock market at 7,007, which is very high. That at the end of the year, this is where the stock market's going to be. Sorry if I wasn't clarifying myself. And this is as of December of last year, right? So the stock market was trending up. Morgan Stanley has it at 6,500 and UBS has it at 6,400. So, okay, now I'm going to read some of these big names that have changed their outlook here. So Deutsche Bank was at 6,800 and now they're at 6,150. Oppenheimer was at, I got to use my finger here to trace this, 6,700 and now they're at 5,950. Barclays was at 6,500. Oh, I can click on the thing. Oh, that's great. Okay. Goldman Sachs was at 6,500 and now they're going to 5,700. JP Morgan was at 6,500 and now their take is at 5,200. Okay. And this is as of Thursday, right? So their takes are as of yesterday, which I can tell you, if you historically look back, it'll probably be very difficult to find this data because they were the maker of it, so they can always take it back. But they're almost always wrong. Almost always universally wrong. And we said it at the earlier of the episode. Not me, not you, not grandma, not Warren Buffett knows what the stock market's going to do. But there's evidence. Okay? And one of the big differentiators in analysts or advisors or any expert really is, do they make claims and then do they stand by those claims? A lot of people are vague. A lot of financial planners are vague. Doctors are vague. Who else would be vague? And a lot of industries are vague, but finance in particular, they're vague because they don't want to be wrong. It's difficult for them to be wrong. And I think one surefire way to not be wrong and to also not be vague is to give a time horizon. Okay, so when you're able to say, okay, look, right now, yeah, probably the next 3 months is going to be a little difficult. It's not going to be good. But what about the next 3 years, right? And you need to be able to look at your own situation that way. You should not be investing money right now that you need 3 months from now. You shouldn't do that. Okay, and I'm speaking from personal experience because I used to do that all the time when I was younger. I'm like, okay, well, if I'm just in Tesla for 6 weeks, maybe it'll boom and I'll get an extra $2,000 out of this $5,000, right? And then Tesla stays neutral and I lose $250, and I'm like, oh, I'd rather just take it out because I need it now. You can't do that. If you do that, you will lose. Okay, and I have clients who took out money on Monday of this week. They took out Monday of this week of companies like ServiceNow and Tesla. Wasn't much. We're talking like 10, 20 grand, but 10, 20 grand in those companies right now, both of those have soared over 10 or 15%. Let me look at ServiceNow, them in particular. ServiceNow in the last week has done 23%. Okay, well, there you go. 23% of $20,000 is $4,000. It's more than $4,000, right? And you have to think that way. You have to think that way. Am I investing for now or am I investing for the future? Because if it's for the future, you need to be patient. If you picked good companies, then just wait, please. It's way too difficult to time the market. And when you try to time the market, you have to consider way more factors than just, are you in a good company? You have to consider when to get in, what to get in, when to get out, and when to get back in. And listen, if you have ever done a parlay, okay, and I think our main demographic here, which I'm not the happiest about, but it's like 29 to 39. Okay. It's that millennial demographic. I'm not too happy about it because I'd rather them invest the money, but we love a good parlay. Okay. That age demographic in particular, FanDuel loves our money. Parlays, you almost never win. You almost never win because you're adding a layer of risk and it multiplies your chance of losing. In the stock market, it's the exact same way. So you're adding a parlay to something that doesn't have to be a parlay, right? Pick a good company in the first place. If you don't want to do it, then pay a professional. But there are absolutely, you need to take them through the ringer, right? You need to ask them questions. And I probably will eventually come with a, hey, if you don't want to use us as your financial advisor, if you don't want to use Brandon and I, then here are the questions I would ask to really pick a great financial advisor. We'll probably do that here eventually because we just want to help you. We don't care if you use us or not. In the grand scheme of things, we want to be a source of reputation, of merit. We want you guys to use us as a library, a knowledge source. Okay, I'm enough. By the way, the stock market just keeps trending up today. We're at 0.74. And with that nod, let's go to our stocks. Okay. So we had somebody who is a loyal listener, constantly listens, and they're in college. They're young, and they want to know about some of the stock picks that we really like because we did this last year. Some of our winners from last year: SoundHound, Kava, Qualcomm, ServiceNow, Palantir, NVIDIA, obviously, Costco, AT&T. So all of those, even with the crappy market, still excellent, right? We were talking about SoundHound in, I think the summer. I think it was $3.50. Shot all the way up to $25. And now I think SoundHound is $9.50. Okay. So even with the crazy market, still up 3 times on your money when we either put client money in or made the stock watch recommendation. And then what else? AT&T. AT&T, we've been watching AT&T since $16. They've consolidated all of their fat. Okay, they are strictly meat, meaning they don't have any real net losers. They don't have an entertainment industry anymore. They're not dealing with any. The entertainment industry was the really, really big one. They're just focused on the meat. There's no more fat. So they just have the 5G towers and they just have the cell phone service. That's their bread and butter. That company, to me, one of the safest companies you can invest in. They have a 4% dividend right now. What are they? They're $26.81, and their all-time high is pretty much $44, roughly $44. So they're $20 off their high, $18 off their high, roughly. This company is very secure. And again, we're talking about, in my head, I get, because I started in the financial planning side of things, I get so caught up in regulation and compliance and is what I'm saying okay and not okay. So I have to clarify almost every point I make. This is not financial advice. This is, not necessarily true for some people, but it is for others and whatnot. You guys, in any field, but especially investments, just like the guy last week, the financial planner that told Deshaun, like, you're in a diversified portfolio. Your risk, it matches your risk tolerance. You're not exposed to more volatility. Like those things, he's correct. Okay, just like someone could look at AT&T and say, "Oh, I don't like the fundamentals of this company. I don't like these numbers." They might pull out, I don't even know what they. Okay, here we go. Let me look at this. Seeking Alpha downgraded AT&T. Okay. As a recession hideout, AT&T is still a decent stock to own. No, here we go. I want to see someone downgrade AT&T. That's what I thought they were going to do. However, fresh capital allocation into AT&T is unjustified given the significant price appreciation experienced over the past 18 months. Okay, so that is someone who's saying AT&T, it's unjustified to be in it, and they're totally entitled to that opinion. You might read that and be like, "Oh, well, I'm not going to invest in it now." But I'm sitting here saying I look at the fundamentals of AT&T. I'm looking at the application of their business. I'm looking at the way that they're cutting down their debt, cutting off the fat of their business, things that are costing them money and not making them money. And they're focusing on what they're good at, keeping the main thing. They're a blue chip company. They're definitely they're a household name. Absolutely. Like those types of things to me, it's like, okay, there's value in being invested in AT&T. And I've been invested in AT&T for 3-4 years now, pretty much since COVID. You can take any data about any one business and you can come up with a negative or a positive opinion. It's very, very possible to do that. You have to be the assessor of your own money. Okay. All the stocks that we pick for people, honestly, there's a lot of people that hate our picks. People were saying SoundHound is a joke. It's a fluke. People were saying Palantir. People are saying Palantir, it's trading 50 times earnings. It's trading way too high of a price for what it's actually valued at. And to that I say you're correct. But that's because there's application to the company. And we're going to talk about Palantir here in a second. And again, I'm going over my 15 minutes. I'm sorry, guys. It's just this is the content that I live for. When I make an assessment of a stock, the finance industry in particular, that's why you can have somebody like Ray Dalio, one of the world's greatest investors of all time, can say, "I see the world's worst market crash coming." Okay, he can say that. And then on the other hand, you can have Tom Lee, who is one of the best investors of my generation, say, "Well, look, we still have a very positive market for the stock market. This thing could absolutely explode and in 5 years be at 15,000. We don't see it being a major long-term deterrent to investing." Those are two extremely different opinions, and they have access to all the same info. How is that possible? And it's because of what people value. Okay. So when I evaluate a stock, what I value first and foremost above any numbers, above anything, is application and evidence. Okay, so evidence to me in a very numerical number is, one, what is their revenue this year or last quarter? And then what was it last quarter and last year? And then the year prior. And if there is a trend of either gross profit margin, which is how efficiently are they making money, right? Are they making money as efficiently as they can, or are they spending a lot of money to get some money? Hopefully that makes sense. If you need a little bit more of a clue in on what that means, just gross profit margin, you can ask ChatGPT. It'll explain it a little bit better. So it's revenue and gross profit margin. That to me is, are they growing with evidence? Like, is there evidence that people are either buying their stuff or they're getting more efficient at keeping the money that they make? And again, my brain is swimming because there's just 10 different variables. I'm trying to give it very plainly so you guys can see how we think. So that's the first part. And the second is the application. Okay. Application. Without a doubt, that's the most important metric. That's kind of how I would say like you're in Barnes & Noble and you see a cover that you like, a book cover. They say, oh, don't judge a book by its cover. But when you're in Barnes & Noble looking at books, it's the good covers that grab your attention. That's what application is to me. I'm in Barnes & Noble of stocks and I'm looking all around and I go, ooh, that looks like a really good cover. That's what Palantir was. Okay. I found Palantir by just reading about different tech stocks, because tech, ultimately, that's going to be where the world goes. So I want to see where these new companies are. And Palantir's been around for decades. They're not new. Okay, but just like NVIDIA, they've been working on a crazy AI concept, quantum AI, all that stuff. Is some of those companies, they're not new. They're 20 years old. And so, excuse me, I'm in the Barnes & Noble looking for great book covers. And to me, I can quantify that and qualitate that for you guys as application. So, Palantir in particular, that is our stock that we love so much. That's the stock we love. I'm living and dying on this hill, which again, find another financial advisor that says these kind of things. It's risky. It's very, very risky. But I'm telling you, the evidence that I've seen from this company, I believe in it. And again, not financial advice. This is just the things at my firm that we really like. And I put my own money in. In fact, guys, I'll give you guys this is how in on it I am, is that I invested in PLTU, which is definitely, don't do this, please. I do not want to get in. This is definitely something that could get me in big trouble. But I invested, PLTU is a 2x leveraged ETF of Palantir. So if it goes up 10%, I go up roughly 20%. If it goes down 40%, I go down roughly 80%. Okay, huge risk, huge reward. I am in that. And I'm not in a lot, just a little bit, but I am in it. I believe in Palantir so much that I'm willing to be in a leveraged position on it. That's pretty, I mean it. I love the company. So please don't do that. But Palantir, the why, right? What's the application? What does Palantir do? Palantir is one of the most complicated companies for someone like myself or the everyday person who's not in the tech space or the military space to understand. And I was listening to some of Palantir's C-suite guys because they do a bunch of interviews all the time because the company is just so impressive. I was able to put it together a visual for them. So for you guys to be able to understand why does James like this company? So we'll just use the military concept first and foremost. So they work in lots of militaries, NATO and mainly US, but they have something called a digital twin. Okay. And a lot of companies do this, but nobody does it like Palantir. A digital twin is effectively a carbon copy of data we'll just use SEAL Team 6. So SEAL Team 6 comes to Palantir and they're like, hey, we have this mission and we want some data on our team. What can you do for us? And they're called forward engineers. A forward engineer will come in from Palantir and they'll gather the data and they will help create a digital twin. Okay. And what that allows these generals, these commanders to do is gather all this data and then put it into a carbon copy, a digital twin, and have actionable steps. So now maybe they say, well, what if we sent, 30% of the team and flanked out the enemy on the left side instead of the right side? And what if our guys took 25 steps to the right instead of coming right down the middle? And they're able to see actionable, percentile differences of results that would happen. Well, maybe our guys, if they go to the right 25 steps, save 25% of their oxygen intake. Or maybe they have to use 10 less bullets because they're able to see all the people all at once instead of going around a corner ready to pull the trigger. Right? And I'm obviously spitballing here, but being able to do those different things, it just allows for so many different options. It's almost like the beginning of Cortana. If you guys have ever played Halo, you guys know what Cortana is, okay? And Cortana and Master Chief are like, Master Chief will be like, okay, where do I go? She's already got the entire map downloaded, and she can say 30 feet, go left. 30 feet, you have enemies coming up on your right. Six live organisms. Like that type of stuff. This is how this begins. Palantir. Okay, this is it. And I'm not doing the very best at explaining it, but it is, to me, whenever I hear, oh, digital twins, okay, the military, they can take data, they can make evaluations on mission decisions, and then they can improve. Well, how could we have gotten more efficient? Okay, efficiency. That's ultimately what Palantir is going to do. How can one man do 5 guys' jobs, right? How can one Navy SEAL do the work of 5 Navy SEALs? And that's what's going to happen. That's what is happening with Palantir. So their Foundry system, they have a whole bunch of other applications, but as they move into the corporate space, so let's just say Dunder Mifflin Paper Company. If Dunder Mifflin would have had Palantir come in and explain the data and show that Office Depot, Office Max, Staples was coming in and they're doing direct wholesale to customer sales, they would have been able to adapt and change and maybe stayed in business because they would have seen the progression of their opponents, or their competition, not opponents, sorry. I guess it's opponents. And they could have made changes, right? They probably would have got rid of Creed, probably would have got rid of Meredith, would have been able just to cut fat off of their business. Hopefully would have got rid of Angela. My goodness, can't stand her. A fun fact, I lived with a lady just like Angela whenever I was starting this business. Guys, it wasn't all glamorous for me. I had to live with a random lady. I lived in a room at her house for 4 months while I was trying to get my feet on the ground. Can I say her name? Anyway, her name was Rita. I won't tell you her last name, but Rita was 68, miserable, exactly looks and personality like Rita. It was horrible. So imagine living with that for 3 or 4 months. But they would have, Palantir would have helped Dunder Mifflin effectively make these changes to become more efficient. Okay, and that's what Palantir is doing with all of these businesses. There is, another thing they do is usually government contracts, when they contract with a company, a tech company or a military company or weapons company, it takes months to get the project off the ground. With Palantir, it takes weeks because the data over the last 20 years that they've been building, it's already there. It's in the foundation of the business. It's a plug and play. It is an absolute no-brainer for the military, for these corporate companies to want to use Palantir because there is no customization that needs to happen. The foundational plug and play system of Palantir works for every business pretty much. And that's why a lot of companies are using them. Okay. There's rumors that they're partnering with Google. There's rumors that they're partnering with the IRS, with Doge, with the border control. All of these rumors, maybe they're just rumors, right? We don't really know until things come out. I mean, look at Palantir right now. Okay. And I'm very excited about Palantir because it's killed it. At its high, it was about 125, and right now it's at 112. Well, 3 months ago, let's not do 3 months ago. Let's do, it was good pretty much every metric. We'll do year to date, and then let me do year to date. Yeah. So then it hit a low with the stock market, right when it was around 4,900. This fell to $74. At the beginning of last year, it was $20. Okay, so this stock has exploded because companies are seeing the application and ability opportunity. Well, no, what is the right term? Not ability opportunity. Expansion opportunity, efficiency opportunity. Let's use efficiency opportunity. They're seeing that in the application. Okay, so and I've been all over the place today. That's why we love Palantir. That's why that's the stock. I think it's the millennials Microsoft. I'm going to be in Palantir for 20 years. Okay? I'm betting on it. I think there's application, and There's also revenue change. So those two things are the most important for me. Now, what can Palantir do to get better? Well, they still have debt. They have their gross profit margin could be better. Still very good though compared to other tech stocks. Still very, very good. And also, Palantir's a little cocky. Okay, they're a little cocky, especially their CEO. That's very dangerous to be bold like that without being able to back it up. But so far, they've been able to back it up. Okay, but there are people, even people that I know, who are like, yeah, Palantir, it'll never be it can't be the next NVIDIA, can't be the next Microsoft, and they'll have a quantitative reason for that, but quantitative data, fundamentals, right, tells you where a company's at. Application shows you where they could go. And that's why I get excited about companies that are, they're a little bit more risky, is because they don't really have the revenue, or they don't really have the numbers to show why they could be great. But we're surrounded by amazing companies right now, the Magnificent Seven. And when you look at Netflix, 2002, you would have told me Netflix would have, 2002 I was 10, but 2002 you would have told my dad, hey, you got to invest in this. It's going to be at that time they were delivering DVDs. You don't need to go to Blockbuster. They'll deliver it straight to your mailbox. You're like, that sounds a little weird. I don't know what you're talking about. Look at what it became. Okay, that was in the early 2000s, mid 2000s. Nobody knew. Nobody knew about Amazon, how great Amazon was going to be. Amazon in 2001, their numbers were excellent. But people still pulled out of Amazon because they were nervous. It was crowd mongering, right? Crowd fear. Other people were getting out of tech stocks. Excuse me. And they're thus, we got to get out of Amazon, even though Bezos literally sent a letter to all the shareholders being like, hey, our numbers are great. Don't worry about the stock price. The fundamental the application of the business hasn't changed. We're still, killing it. Well, look what would have happened if you stayed, if you had Amazon for 26 years, if you would have had it in 1999, 2001, right? These are the kind of things that your fundamental analysis, your quantitative data doesn't actually tell you, and you have to be able to make an assessment of these companies. Okay, so the last one we're going to talk about is Tesla, and I'll be very brief here. Tesla, we love Tesla. I didn't like Tesla in 2019. Okay, I thought it was extremely overbought, extremely overpriced, extremely overvalued. But that's how people think about Palantir and NVIDIA and Amazon in 2001. I was wrong. Okay, I admit it. I was wrong back then. I was also, a little green in the industry, but Tesla is not just a car company. They are $3 trillion businesses into one company. Okay, battery storage, battery packs. Huge industry. They're at the forefront of that. Second is robots. Okay, that's going to be a massive, massive space for them, probably in maybe 5-10 years. Third is the robo-taxis. Okay, robo-taxis. How do you not hear that and think that's absolutely going to be a future? That's absolutely in the future. That data that they've had, Tesla is one of the companies that when you bought a car, you were effectively giving free data to Tesla. And I've never actually seen a Tesla contract or whatever the process is that you go through, but I know that the information in the car was stored and compartmentalized for use later. That's why this robo-taxi business for Tesla is going to be so amazing, is they have 10, 15 years of Tesla data. Okay, Toyota doesn't have that. Ford doesn't have that. Rivian, none of these companies have that. Tesla does. They are going to be able to be way better at the robo-taxis than pretty much everybody else. And I say that as someone who doesn't really like Tesla cars. I think they fall apart on the highway. I don't like how the battery's built into the chassis, so you have to get a whole new car when the battery goes out. I don't like that. None of that matters to me because I see the effectiveness of those three separate industries, and I just say, how could you not, right? The application is there. The application. And I'm at 40 minutes now. I've really, boy, have I done it. I might have to change it to 40 minutes of finance. I think that might be, of course, I won't do that. Most of the time, these are 15. I think we average about 18 minutes, just so we're clear. But to answer the question of the stocks we like, right? A lot of it's the same. We love Tesla. We love Palantir. We love NVIDIA. We love AT&T. We love ServiceNow. Okay, those are the stocks that we're watching, that we like, that our clients are in. And then let me pull up some of the new ones that we're just watching. I'll admit that these ones that I'm going to talk to you about, we haven't put any money in, but I'm close. So the first one is HIMS. Okay, HIMS is the ticker. Where else is it? KULR. Okay, that might be a popular one if you guys follow Wall Street Bets. And then Applied Digital Corporation, APLD. NVIDIA is a buyer or an investor into them. And I just want to tell you guys the tickers and let you guys go do your own research, because I haven't done enough. But there are things that I like about each of those companies where I'm like, oh, maybe I should do a little bit more research into it. And look, right now we are in beta creation stages, excuse me, of a 77 Financial Group scorecard, meaning I want to be able to pump a brand new stock, right? I want to be able to pump Applied Digital Corporation, APLD, through this grade system, and I want to be able to get a grade out. And that's extremely, extremely difficult, because I value companies way differently than just the fundamentals. Because of that, there has to be some, wiggle room, like standard deviation on the value of these quantitative data intakes. So, someone might have a earnings per share that I think is way too high, but I really like a certain thing about it. Maybe their gross profit margin is really great. That's one of my favorite metrics to use. It shows gross profit is effectively how efficient you are at making money. And I love that. I love that number. So we are in the process of making that. Nowhere near done with that. It's just too complicated right now. So especially with the market being down, a lot of my time is either new clients or talking to current clients about why what they're in is great. Why, talking them off of the sell hill. Because if they would have sold 6 weeks ago, 4 weeks ago, they wouldn't have gotten, I haven't had drinking water. I haven't drinking water in 42 minutes. So I'm feeling it. They would have missed out on the 500-point gain we've just had in the last 4 or 5 weeks. It's like that type of stuff is why you got to play the game. Okay. And that's what we're here to help you do. Okay. You don't have to use us, but we hope that you utilize us, if that makes sense. We don't have to be your financial advisor or your CPA, but hopefully you guys like what we're saying, because I'm providing actual in real time perspective and data on the market, stocks, financial planning concepts, all of these things. Okay. There's just value in, one, being transparent, and two, saying this is what we think is going to happen, but we don't know. And that will always be what we try to do. Again, guys, not financial advice, but I hope you enjoyed that. Please take a look at Palantir. I'm not telling you to buy it. I'm just telling you to look into it. Okay. Palantir, ServiceNow, Tesla. I mean, these are companies you should probably already know. They've been in the news for a really long time. All right, guys, that is it. Oh, also at the end here, and I'll probably say this for the next couple of episodes, but me and Brandon are trying to do something new. We want to offer free financial plans to all of our podcast listeners. Okay. And we're only going to do this maybe once a quarter. So coming up in May, we'll have meetings with people, and we'll just say, hey, normally this is a $2,000 cost, which normally it is. But for 1 month, we're going to do it for free. Okay. What's the value in that? Massive value. You're going to get effectively our professional opinion about where you're at, and then what you need to do to get to where you want to be. Okay. There's thousands of dollars in value in that. Now, you don't have to utilize us to implement it, but you can if you want, or you can take what we have to say and just go on your way. And then you can wait a year, 2, 3 years and be like, oh, the guys at 15 Minutes of Finance were right. I should have done that. Or, wow, I'm really glad I did what they told me to do. Okay. So in the month of May, we're going to offer free financial plans for all podcast listeners. That is, I would tell you, the number one thing that young people should have done is they should have got a measurable, actionable, step-by-step plan for their investment, for their investments, all of them. Their 401k, 403b, emergency account, life insurance, the inheritance they're going to get, all that stuff, okay? That is how you really become wealthy, is you have a plan, you stick to it, and you believe in it. And also when the stock market drops 1,400 points, you can say, oh, I have a plan, right? And it keeps you, it's a little bit of a barrier from falling off that cliff, falling off that sell cliff, okay? Anyways, guys, if that interests you, please reach out to us. Our Instagram, 15_minutes of finance. We have a Twitter, 15 Minutes of Finance, Facebook, 15 Minutes of Finance. You can go to our website, Weston Walters Wealth. What is our website? Weston Walters Tax and Wealth Management.com. All over the place. Write a comment on Spotify, right? Or wherever it is you're listening to it. Well, maybe don't do that because we probably need your email and stuff. But anyways, there's ways to get a hold of us. We're happy to help you. And look, that's what we're here to be, a resource for you. So I dare you to find a financial advisor or CPA that's doing this. I dare you. There's just, I don't know any. I don't know a single one. But anyways, guys, as always, invest early, invest often. We'll see you guys next week.